What's going on, everybody? Jeff here. Welcome back to the channel. The choppiness continues. Market opening up strong, especially after yesterday's event, only to give back all of the gains. In this video, I want to go over something very important, and it's history. Because history is the only indication of what is going to happen in the future. We go over this when it talks about the charts, when we're going over in the mornings, charting our lines of support and resistance. All right, by looking left to give us indication of what is going to happen to the right. Going over history is the same thing, but it's a much larger time frame. And we're also taking a look at some of the events and the news behind the movement as well. But before I get into it, I want to talk about what happened yesterday. All right, not raising interest rates was a good sign. Not giving any time frame on when the balance sheet would be sold off was a good sign. However, here's where things went wrong a little bit. Jerome Powell had stated that if he was to redo his numbers on the December inflation, the numbers would actually be far worse than expected. Okay. Now, the saga has just only continued to unfold even more, and it's a snowball effect where it's a little snowball just rolling, getting bigger and bigger. They went from inflation's not a problem to inflation will be transitory, till inflation's a little bit of a problem. So now inflation is a big problem. And then also, just to top it off, inflation's actually worse than we thought. So it's only gotten worse. Okay. Now, I've been saying ever since August, as I trimmed down my long positions, I'm not talking about AMC. All right. And I went to slowly playing day plays. All right. I went from a 20% cash basis all the way to about 85% cash basis at this time, because inevitably we could see that the quantitative easing, okay, the stimulus, all right, the free money policy had to end. All right. But if you're caught up in the middle of it right now, I'm going to give you my just opinion on what is happening. All right. And by taking a little bit of a look at history, might ease some of those fears going forward. Okay. So let's get right into the video. First off, let's take a look at the charts. As you can see here, from this 480 level getting down to about the 430, 420 as a low, that is about a 11 to 12% drop from all-time highs. All right, that is officially in correction territory. If you take a look at where we are, to zoom up from all-time highs, down 11%, that is officially in correction territory. Down 10% is correction territory. Down 20% is entering into a bear market. There's a couple things I want to mention first. The market is very forward thinking. It reacts very quickly, very dramatically, which means these downfalls, if you look at this on the daily chart, as I'm looking at on the 1 hour, you go over to the daily chart and you could just see nothing but red straight down very, very quickly. Okay. There are a couple things that investors are going to eye very closely ahead of March. Okay. Because that's when interest rates, to our knowledge, are first going to start to rise. They're expecting a 0.25% or 25 basis point raise. All right. Jerome Powell has dragged his feet the entire time. And there is a huge part of me that thinks he will continue to drag his feet. All right. I've mentioned this in other videos, also stating it's an election year, causing a potential recession, looking at, and we're also going to take a look at what happened in 2017 and 2018 in just a moment. Okay. But just seeing that it's going to shock things a little too fast. However, he's also in a predicament that in order to really get things done, he might have to raise it 50 basis points, shock the system, okay, to get things moving. All right. The time frame on that is, like I said, it's about March. I think it's March 16th. So we're less than 2 months away from that. In between them, I think we're going to get a little bit of a relief bounce. All right. Not to say go all the way back up. It's not going to charge. So don't get too excited. A little bit of a relief bounce, just because naturally nothing can go straight in one direction forever. All right. And then it's going to be the same thing, a solid grind, anticipation, and waiting, a little bit more choppiness. But there's one thing I want to point out on top of all of this. And if you jump over here to the weekly chart, I'm going to go out to 10 years. Okay. So we went through big issues in 2008 from the mortgage-backed securities defaults, okay, from the Great Recession, okay, to a whole bunch of issues. And the Fed did everything in their power, all right, maybe not as drastically as they did with COVID, but everything in their power to help support the economy. And in 2015, they started talking about raising interest rates. All right. The first interest rate raise was in the fourth quarter, I think it was December 2015. All right. And if you look at where December of 2015 is, okay, it's right here. All right. And the charts. And you can go take a look at this 10-year weekly chart for yourself. All right. But when they started talking about this, it was June, July. And if you look what happened in August, we dipped for a total of a 15% drop. Okay. Even though rates, this was in August, September, even though rates did not first get raised, okay, until December. And we popped back up. A little bit of a relief. That did not last, and it continued to come down. And look where we moved for the next, all the way up until probably, let me see this time frame where we're at, 2018. Now, in that time frame, in 2016, rates were not raised. 2017, rates were raised, I think, 3 times. In 2018, rates were raised 4 times, bringing the interest rate, the Fed fund rate, all the way back up to 2.5%. And you can see what happens when they talk about it, that market reaction, the knee-jerk reaction, okay? Now, retail is always the first one or always the last one to sell and the first one to and the last one to buy, okay? That's exactly what happens. It shocks them. The institutions are the first ones to get out. The funds are the first ones to get out, all right? They know this game better than anybody else, okay? And they get right back in to play some of the relief, and they ride it. But as you can see, the long-term trajectory of the market, it recovers. It does take time, but it does recover. Now, things are a little bit different in this situation. First of all, inflation was not rampant like it is now, okay? And also, you do have some other issues. One being the COVID lockdowns, which I don't see too much straining the United States as of right now, okay? But the biggest thing, like I said, inflation was not running rampant. Also, there was a ton more stimulus pumped into the economy as of right now, and their balance sheet is worse than it is. But I do want to point this out when people do look at the charts. The biggest difference here is there's just more money inside the market. And what I mean by that is because of the easily accessible markets where you have trading apps and everybody has smartphones, okay, it naturally puts more players in the game. All right. So when you look at this trajectory, you have to take that into account. There's more money in the game and there's more players in the game. Okay. So even though it's ramped up a little bit, okay, from COVID, okay, you do have to put that into effect a little bit. But like I said, it reacts very, very quickly. Okay. So I do think we are going to get a little bit of a relief bounce. I made a video at the beginning of this year stating that I still do not think we are going to get a market crash and everything would be dependent on inflation. And as long as the inflation can just not get worse from what it is, okay, now he wants to get it back down to 2%, and I just don't see that happening, especially this year, okay? But as long as it can not get worse than it is right now and they continue to raise rates at a slow pace, all right, the market will adjust very quickly, okay, like it has, and it will continue to grind out and make its moves to the upside like the market naturally does. All right. If we do look at where we stand, I'll zoom in just a little bit to the daily chart. We are seeing a bit of consolidation here. That 430 level on SPY is strong, acted as strong support. You can see these long wicks right here, all right, are a bullish sign. And I said that thinking that we would get a bounce, which we did, all the way from that 420 level all the way up to about 440, about 444, which was a sick bounce, especially when it comes to, you know, a full indice. But having the Fed, the FOMC, okay, meeting and Jerome Powell speeching could have put all of this to a halt, which clearly it did. But we didn't break down below that 420 level. So just keep that in mind going forward. The last thing I want to point out to everybody, and this is a screenshot somebody shared inside the group, all right, as I was sharing my whole, you know, thesis and hypotheses about what I see happening, was this right here. If history is a guide, okay, that if you look at the days to 10% correction, if you look at the next 6 months, there's a bounce. There's a bounce from where it hits, okay? So just keep that in mind going forward, all right? If you are in any of your long positions, I will say this, I do not think that this is the bottom. We're going to get a relief bounce and a ride. Not at all. I do think we'll get a relief bounce. We'll come back down try to test those levels, have these current levels, try to hold at support. Then we can ride up, break at these levels. Then we'll have to reevaluate all of this. But like I said, we still do have some time ahead of us. Keep the March date on focus. I'll continue to cover all of this. And like I said, once I can start adding back to my long-term portfolio, I will start telling everybody. If you are not a day trader and don't have the interest or the time to be able to day trade, dollar cost averaging into positions very slowly is your best bet. I've said that before. That's why 401ks are always successful. It's because they buy when it's high and they buy when it's low. They're buying non-stop. Naturally, the market goes up. So allocate, your funds that you have right now over the next 12, to 24 months, and every week be able to slowly buy. There was a time, Tesla is now breached below 850. It was just at 1200. Okay. And there was a time when it was at 1200 when everybody had said, oh, I wish I could have bought it at 850. Well, now's your time. Just don't go all in. Realize there's some of the risks that you have ahead and be able to move forward. So that's it for this video, guys. I'll see you in the next one.